The US economy grew 2% last quarter. Sounds healthy. Sounds like everything's fine. It's not, because if you strip out AI spending from just 4 companies, the economy actually grew about 0.5%. Meta, Microsoft, Google, Amazon. They're spending $725 billion this year on AI infrastructure, and they are literally the only thing standing between us and a recession. OpenAI just blinked. The cracks are showing. So let me show you exactly what's happening, why it matters for your money, and the 4 moves to protect yourself before this house of cards starts to wobble. The Bureau of Economic Analysis dropped the Q1 number on April 30th, 2.0% annualized growth. Wall Street called it solid. The headlines called it a rebound. Here's what they didn't tell you. Business investment grew at 10.4%, and almost all of it was AI infrastructure. Information processing equipment alone added 0.8 percentage points to the GDP number. Software added another 0.6. Add those together, and you get nearly 1.5 percentage points of growth coming from one thing: companies building data centers. Subtract that out, and the rest of the American economy grew around 0.6%. Consumer spending grew 1.6%. And even that's a lie, because services carried the entire number while goods spending actually declined. Americans are still paying for streaming and haircuts, but they've stopped buying stuff. Fed Chair Powell himself called it apparently insatiable demand for data centers. That's the head of the Federal Reserve admitting on the record that the US economy is being carried by server racks in Virginia. So how big is this AI bet really? Meta is spending up to $145 billion this year. Microsoft around $190 billion. Google up to $190 billion. Amazon $200 billion. Combined, $725 billion, equal to the entire GDP of Sweden, spent by 4 companies in 1 year. Now the obvious question, are they making it back? Goldman Sachs ran the math. To justify this capex at historical returns, these companies would need to generate over $1 trillion in annual profits. Consensus estimate for 2026, about $450 billion. They are spending more than double what the math says they can earn back. And it gets worse. The National Bureau of Economic Research released a study in February. They surveyed companies actually using AI tools. 90% reported no measurable impact on productivity. 0. The biggest infrastructure boom of this generation, and 9 out of 10 firms say they can't see the benefit yet. Then on April 27th, the Wall Street Journal dropped a story that should terrify you. OpenAI is missing its internal targets. They wanted 1 billion weekly users by the end of 2025. They hit 900 million. They missed monthly revenue targets repeatedly. ChatGPT's share of AI web traffic collapsed from 86.7% last year to 64.5% in January. Google's Gemini quadrupled its share in the same window, the market noticed. Nvidia dropped. AMD fell as much as 11% in a single session. ARM dropped 9%. Oracle fell 7%. SoftBank cratered 10% in Tokyo. One leak, about one company, wiped hundreds of billions in market cap in a day. And here's the part nobody's saying out loud. Microsoft has $13 billion sunk into OpenAI. If OpenAI struggles, Microsoft has every reason to slow Azure capex. And if Microsoft slows, the dominoes start falling everywhere. Picture this. Just one of those 4 companies trims capex by 20%. That's around $50 billion vanishing from the GDP equation overnight. Nvidia controls 90% of AI chips. Their stock would crater. Your S&P 500 index fund, the one inside your 401k, is roughly 33% tech and over 50% when you count tech-adjacent names. That's your retirement leveraged to 4 companies' spending decisions. Meanwhile, inflation is still sticky. PCE at 3.5%, core PCE at 3.2%, oil above $100 a barrel. JP Morgan now puts recession odds at 35%. Moody's puts them near 50%. Even Jamie Dimon is calling stagflation the skunk at the party. The Fed can't cut without lighting inflation on fire. They can't hold without watching growth collapse. That is the trap. So here's what you actually do. Move 1. Trim your concentration in tech-heavy index funds. Something like VTV gives you broad exposure without betting your retirement on 7 stocks. Move 2. Add a 10 to 15% sleeve in energy. With oil above $100, energy is your inflation hedge. XLE is the simple way in. Move 3. Build cash. SGOV holds short-term treasuries yielding around 4.5%. That's a real return while you wait for clarity. Move 4. Do not use leverage on single AI names. Nvidia could drop 40% on one bad earnings call and never come back. Don't fully exit either. That's how you miss the rally if AI actually delivers. Just stop pretending the headline GDP number reflects what's actually happening on the ground. The economy isn't healthy. It's on AI life support. Four companies, $725 billion in capex, propping up a number that would otherwise be flashing recession. OpenAI just gave us the first crack in the wall, and the entire AI complex shook on a single leaked memo. This isn't the moment to panic sell. It's the moment to stop trusting the headline and start positioning for the world the data is actually describing. Trim the tech concentration, add the energy hedge, build the cash position. Stay disciplined while everyone else is staring at the GDP print and pretending the foundation isn't made of one industry's spending plans. The people who position before the narrative breaks are the only ones who win when it does. Hit like if this opened your eyes. Drop a comment. Are you still buying tech at these levels, or are you taking profits? I want to know. See you next time.